The banks are in a very different situation than they were at the end of the global financial crisis. They actually have a huge amount of capital spare. Some people argue they're overcapitalized. So I actually think that I do have confidence that these dividends are going to be sustainable and are going to possibly even grow slightly from these levels. They are below the pre-pandemic levels, so the banks haven't resumed completely paying back regular dividends at the same level. What they are doing is, where they have excess cash, is paying out some special dividends or doing share buybacks.
What's interesting, I think, is where you look at the geographical breakdown of dividend payouts through this period, and what your report exposes is the fact that emerging markets are actually going in the opposite direction, that dividend payments were down 3.2% year on year. Does that expose the fragility of the economic recovery for many of these economies that just don't seem to be participating alongside the United States and Europe?
I think if you remember, the emerging markets didn't cut their dividends anything like the cuts we saw in UK and Europe. So all it is they're playing a tiny bit of catch up because they've waited for their 2020 results and then they're cutting dividends on the back of that. In the UK and in Europe, many companies cut their dividends preemptively ahead of actually the impact on profit. So it's just a timing thing. And I don't think we should be too concerned about the outlook for Asia and emerging markets.
And just to pick up on Steve talked about gearing, but can I ask you about inflation and the prospects that we're going to see margins and profitability clipped by rising input costs? Is that something that is of a concern at this point to an income investor?
We're looking very much on a stock-by-stock basis. Some businesses and some industries clearly have more cost pressure than others. But it's also important to point out that we're seeing quite a lot of companies where they're able to pass those prices on. So it's not got such great news for us as consumers, but we're actually seeing revenues increase because those prices are being passed on. So there is some pricing power. So it's very industry and company specific with regard dynamics around margins. And so I think we just have to be aware of some of those things when looking at individual stocks.
Jane, let me ask you an existential question, I guess, for the markets as well. How important is increased equity income for investors for the future of equitisation at a time when I guess people are beginning to look at the opposite side of the coin, the de-equitisation? They're actually never getting to public markets as well because of the vast amount of money in the private sector. I guess for you and your investors and your colleagues, it's actually stunningly important.
Well, we want to be able to have companies that we can invest in that pay dividends and that grow those dividends. That's most important. Clearly, we're seeing quite a lot of interest from private equity, particularly in the UK equity market. And that's just reflecting how cheap some of these companies are. And investors have largely ignored some of them, particularly in the UK. And other people are coming in and starting to take advantage of those valuations. We ultimately think that it's quite helpful in that people are pointing out how cheap some of these companies are, what the incredible levels of cash that they're throwing off. And so clearly we don't want everything taken over, but we do think it highlights some of the value available in some of these sort of out of favour companies that have still got very strong dynamics and very strong cash flow.